Hi, I'm Kison with Fundology. I'm here with Brian Demkowicz, Managing Partner and Co-Founder of Huron Capital, a Detroit-based private equity firm. How are you, Brian?
I'm good. How are you?
Great. Brian, so I've learned your firm has done more than 20 exits, and I wanted to talk to you today about the process of planning and making a successful exit.
Okay. It's always generally between a 4 to 7 year window when we look to exit. You know, some investments are designed to exit a little quicker, some are designed to exit a little bit further down the road. And so we always have an idea in mind, and there's always 4 to 5 key milestones that we'd like to achieve in the investment in order to exit. So it's really kind of with that in mind that we put all of our plans and execute toward that. And in certain cases, there'll be additions to the management team. There'll be improvements to the operations. There'll be improvement from a sales and a geography standpoint. So there's 4 or 5 key levers that we want to pull to create value. And in certain cases, we're able to execute on that very quickly and be prepared within let's say a 3 or 4 year window to exit. In other cases, it proceeds on plan, in which case it'll probably be in the 5 or 6 year window. In other cases, you may have a recession, which could impact timing. In which case, you might hold on to an investment a bit longer in order to achieve the exit that you're looking for. So, but I think in general, we do look at a 4 to 7 year window to exit, and we've been very successful in being able to achieve within that window.
So Brian, when you reach your milestones, how much time or window do you allocate for making an exit?
Well, I think, in some cases, we've been able to achieve the milestones very quickly, and we've exited, in a couple of cases as early as 2 to 3 years, and where we were approached by a strategic acquirer. We weren't out looking to sell, but we were approached. The offer was a very good one, and so we were compelled to sell in those cases. But I would say that in the vast majority of cases, working with the management team, our kinds of transactions take really 3 to 5 years in order to achieve everything that we want to achieve, and so we don't do turnaround kind of deals, but they're deals that have a story to them. There's something that changes within the business that need to occur in order to achieve the return, and that's the reason for our involvement. So, it's usually within that 3 to 5 year time frame that we figure out that we've achieved what we need to achieve and are ready to prepare the business for sale.
Great. Could you tell me about some of the specific steps to take in planning an exit?
Sure. Again, it really starts at the beginning. As soon as we get into an investment, we're starting to think about the steps we need to take to exit. And so, how do we best position the company for sale for a very, we have a very specific universe of acquirers in mind, both strategic and financial. And so it's really about making sure that the trends are going in the right way. So making sure that the revenue line and the EBITDA line are going up and to the right. Typically it means we've improved margins, we've improved the growth profile of the business, we've increased the depth of the management team. And again, it usually takes about 3 years to be able to do that. We always have an idea of who will be our advisor on the transaction. And so we start that process very early. If we know that we'd like to exit somewhere in the 5th year, somewhere in the 3rd year, we're probably talking to a handful of investment banks and maybe even selecting our investment bank so that we can work with that bank over the next 18 months to position the company for sale. That's a very big part of it. And so it's really having a pretty clear vision of how we'd like the business to look at the time of sale, and then working backwards 18 months or so and selecting the advisor and making sure that we're doing all the right things leading up to the ultimate exit.
Now that's interesting that you start working with an advisor pretty early on. Could you tell me a little bit about that relationship and what's accomplished at that point?
Sure, we have relationships with lots of investment banks, and typically there's subsets of these banks that have a very particular interest in many of our many of our companies, and so we figure out. In fact, we have a clear idea now for every one of our companies. A small universe of investment banks that would be we believe would do a very good job selling that business. So about 18 months to 2 years prior to sale. We started having more active discussions with these investment banks. But the idea that we'll pick one advisor who will help us through the remainder of that process. And the benefit of picking the advisor early is they can give us insights into the market in terms of timing. There's no rush in terms of having to prepare the material to go out to the market. And it also allows us to take advantage of timing. If we need to advance the process, we're able to do that very quickly. But again, it gives us the luxury of time and going out in a relaxed manner. In a lot of cases, too, it allows the investment banker to on a very confidential basis, get the word out into the market that the company will be coming up for sale. And it allows those strategics, if they have an interest, to preempt the process, and we've seen that in a number of cases where that's worked out very well, where we've had designed to go out in a process, and because of the fact that we hired our advisor early, we're able to get a lot of interest going even before the sale process, and so we found that to be a pretty good model for us.
So it sounds like that time helps to make everything well planned.
It does, and it really helps us with timing, and it really helps the investment banker to prepare the information. They get to know the team, and they really, we use them as a pretty good advisor, pretty strong, as part of our team, and helping us position the company for exit.
How can an investment bank win your business?
I think being proactive and bringing ideas to the table. And giving the appropriate level of attention. We've had where we've invited some folks come in and to look at some of our companies, and really it was evident they didn't really put in the time. They didn't ask the appropriate level of the depth of the questions, and it was pretty evident they hadn't done their homework prior to that. They need to demonstrate they have that this relationship is important to them, that this particular business will command that kind of attention within their firm. They need to demonstrate that they have the requisite level of experience within this sector, or at least the broad sector, that they have the capabilities to get this done, and have a track record of selling these kinds of businesses.
Great. How do you work with your bank to come up with a target price?
We have a kind of an internal price in mind, and it's a price that we certainly have an estimate of that at the time of making the investment. And of course, many things change over time. But I think it's really getting guidance from them in terms of what they're seeing in the market. We're seeing a lot of things too, but we really look to when the investment banks first come through to really have them give us guidance on what they're seeing in the market. And there's usually a range of high to low, and then there's an expectation that we kind of anchor. And usually the investment banks that we have come through, usually they're pretty close. I mean, they're all very good, and they're all very well attuned to the market. And so there's a very narrow band of valuation that we would be looking at, and then we internalize that and kind of decide if that's a valuation that we're willing to go forward with, and if not, then maybe we wait. If it is, then of course we might accelerate the process. So it's really working with the investment banks and understanding where they're coming out, based on their experience.
Okay. Now, from the point when you engage with them, investment bank, what's done to prep the company for a sale?
Sure. I think at the point of really going out, and kind of working backwards again, as I mentioned earlier, you want to make sure that things are going in the right direction, that it has a team that's a fully functioning, high-performing team that will continue with the business. You want the revenue trends up and to the right, so you want to see retention of customers. You want to see new customers. You want to see operational improvements that have taken hold in the business, so there'll be an upward trend in the operating margins, and therefore the EBITDA of the business. You want to see debt going down. That's the other component that's important during the life of our ownership, is that there's significant debt repayment. And so generally, you want to see the trends of the business going in the right direction.
Great. Could you contrast a little bit, Brian, on your experience between strategic buyers and financial buyers?
Sure. I think that we are, I wouldn't say we're indifferent, but our view is that the strategics can always afford to pay more, and particularly if it's a public company, you can kind of see where the stock is trading at, and you get to a level where the business, sort of the high end, where the business, a price would not be accretive, and so you can kind of get to a break-even point. And so, but there are trade-offs. Strategic acquirers typically can take a little bit longer because of the bureaucracy. We found that, and so they can be a little bit more difficult to deal with. From a PE buyer's perspective, clearly, we think a lot alike. We know what the issues are. We can anticipate those issues, and financial buyers over time, particularly in this market, they tend to move very quickly. And whether it's a financial buyer or a strategic buyer, we try to put them on a level playing field. And so we try to outline a time frame that's aggressive, and we try to input milestones so that when they reach a certain milestone, maybe at some point you grant exclusivity, or certain things have to happen. For instance, the completion of the financial audit or completion of the purchase agreement in order to continue in the process. But I would say that the gap between the financial buyer and the strategic buyer has closed dramatically in the last number of years.
Are there any other trends that you've seen over the years? I know you've been doing this for a while, and just implications of new technology and platforms, market transactions, market deals. Have you seen any major effects from those things?
I would say that maybe not so much from a technology standpoint, but just the market's even more efficient than it was before. You see a lot of the bigger firms that have an effort to come down into our market and acquire things, perhaps more with an annuity kind of return in mind. And so companies that would have traded maybe in the 5 to 6 times range are now trading in the 7 to 8 times range. And so the market is sort of out of whack from that perspective, and that has a way of catching up, and so that'll kind of take some time to sort itself out. But I would say that buyers are just being very, very aggressive, particularly for businesses that we view as somewhat mundane, kind of slow growing. Other buyers may view that as more of a safe area to put some of their capital without having thought through how they're actually going to grow it. But in terms of any trends driven by technology or anything to make the process more efficient, the only thing I cite maybe is the emergence of the rep and warranty insurance. It's not a technology issue, but it's simply a tactic that we've used as well, just to make it easier for the buyer to walk away on a clean basis. There's a cost to it, and it's just negotiated within the purchase price. But that's sort of a newer way to get things done and becoming more commonplace.
What does that cover exactly?
It covers all the, generally it covers all the reps and warranties that would be inherent in a purchase agreement, and so after you negotiate the deductible on the baskets, everything above that would be covered by insurance. And there's a handful of insurance companies that write that kind of insurance. There's a cost to it, and then it's just a matter of how that cost is split in the purchase price, and it comes out in the wash. But it's a common way for buyers to distinguish themselves in a process, and particularly for those sellers that are really concerned about ongoing liability.
Interesting. Have you seen more family offices?
We have seen family offices that have historically invested in private equity funds that are, considering the possibility of doing that on some level, but also starting up their own operations in order to save on the management fees and the carry. And so we are seeing some of that in our market, and their pitch, against groups like ours is that they're a family operation, they have a long-term hold, there's no set time window in which they have to exit. But again, on the flip side, they don't necessarily have the experience of, they don't have a long track record of doing this. But again, there has been a surge, I would say, in the interest of family offices of competing against us.
Great. Brian, what would you say are the keys to making a successful exit?
The keys, there's, I would say that, diligent management along the way. We're an investor that works very collaboratively with the management team, and so we're not ones to sort of invest and then, check in every quarter. And so it's really having from the start a very well thought out plan that you're willing to modify based on changes in the business. It's always keeping focused on those 4 or 5 levers that you can pull to create value, and having a vision of what you want to create. And if you're a $10 million business now and you want to be 30 at the time of exit, it's having a clear vision of how you get there, and making sure that the management team every step of the way is on the same page. Because if they're not, or different visions of how you get there, it's not going to work. But it's really being disciplined about following the plan and changing it if you need to.
Now, are there any hurdles to look out for?
There's hurdles in every business. Even some of our companies that are performing really well, there's still challenges. We just had a meeting this morning, a 3-hour meeting covering every company in the portfolio, and even on the ones that are high performing, there's always challenges, and you tend to focus on those. But I would say just making sure that like in this economy where we had a pretty rotten first quarter, generally, down 3%, and the rest of the year it sort of looks okay, not great. That creates more hurdles in the business but you just have to be prepared for that. So, I think the hurdles really are making sure that the management team is on the same page, and so we do a lot of communicating with the team, making sure that we're all rowing in the same direction. In this environment where retail sales are down, that's always a key hurdle with regard to our consumer product businesses. But I would say the hurdles are the economy, which it is what it is. You just have to overcome it, and making sure that you're aligned with the team every step of the way.
Great, Brian. I think that's all I have about planning exits, and I've learned a lot.
Okay.
Do you want to tell me a little bit about the type of deals that your firm looks for?
Sure. We're lower middle market firm, and we focus on companies that generally have revenues between 20 million and 200 million. We look at the situations that are unique, and maybe there's a bit of a story. It's not your plain vanilla cookie cutter situation. It could be a carve out from a bigger business. It could be a family run business where the owner's been an absentee owner, and the existing management team is now ready to take control of the business and move it forward. But these are businesses that are generally underperforming relative to their potential. With our capital and our kind of our toolbox of resources, we can work with the team to get it to a higher level. And our hope is to double or triple the size of the business during our ownership. We focus on 4 primary sectors. One is specialty manufacturing. Another sector is business services. We focus on consumer product companies, and we focus on healthcare companies. And within those 4 lines of business, we look for businesses that have been challenged in some way that we believe we can work with the team, pull 4 or 5 levers, create value, and double or triple our money over time.
Now, are you guys geographically focused in certain areas?
We are nationally based, although there are certain areas of the country where we tend to focus a bit more, which is in the southeast, the Midwest, southeast, and Canada. And if you look at our deal flow, about 80% of our deal flow comes within those regions. Having said that, we also have been generating a fair amount of deal flow on the Northeast and the West Coast, but I would say for the most part, we are a Midwest-based firm, kind of Midwestern values. But we do operate we do operate nationally.
Great. Brian, thanks for your time today.
Great, thank you.